to Micron Technology, ticker MU.
Yeah.
And it's all because of a move so powerful it has, well, it's basically redrawn the map for the whole semiconductor space. I mean, let's just start with the numbers. They're pretty staggering. We're talking about a single-day surge of over 10%.
In one session. It's a massive institutional signal.
It is, and it just catapulted the stock past its old ceiling to a brand new all-time high, just a little over $343. This wasn't a gentle push.
No, it was a fundamental break. But I'd say it's more than a break, it's a confirmation. And our mission for you today is to analyze why this move, this really aggressive move, validates the acceleration of what we've been calling the AI supercycle.
Right.
The market is placing a huge high-conviction bet here. And crucially, the analysis shows Micron has entered what's known as blue sky breakout territory.
Blue sky breakout. That's a phrase we absolutely have to unpack. But the most fascinating tension for me in this whole report is how it just tackles that investor skepticism head on.
You mean the it's too high argument?
Exactly. Everyone sees a 10% jump and thinks, I missed it, it's too high. This analysis argues that at 343.3, Micron is, fundamentally undervalued.
Because there's literally no resistance left.
Okay, so let's start at the very foundation. What are the structural forces the analysis pointed to? What gave this move so much power?
Right, because it needed real earnings potential behind it, not just hype.
Yeah.
And the key distinction here is that this wasn't about a future rumor. This was the market finally accepting the current reality, which is that the AI memory supercycle is accelerating fast.
So if you were skeptical before...
This price action is the market basically shouting you down.
Right.
The driver is the incredible demand for high bandwidth memory, or HBM.
We hear about HBM all the time, but what's the verifiable fact in the report that proves Micron now has all the pricing power?
It really boils down to one word: scarcity. Right. The analysis calls it the sold-out narrative.
It's sold-out narrative. Okay.
Yeah, I mean, think about this. The major memory suppliers are essentially sold out of their top-tier HBM chips for the next 12 to 18 months.
18 months.
A year and a half. Their production is already spoken for.
Wow. If capacity is locked up for that long, it just fundamentally rewrites the margin story, doesn't it?
Completely. Standard DRAM memory, that's a commodity. HBM is proprietary.
So the power shifts.
It shifts entirely to the manufacturer. And this is where the deep dive gets interesting, because it's not just about volume, it's about margins. HBM is just dramatically more profitable.
How much more?
The report notes HBM modules can command multiples of the price of standard DRAM, sometimes 3 to 5 times more.
So, okay, that 57% revenue growth they cited, that's not just more chips, it's an explosion in the quality of that revenue.
Exactly. The margin expansion is the critical piece here. Institutional buyers aren't just reacting to revenue. They're reacting to the clear expectation that earnings per share EPS is about to double.
So not linear growth.
Not at all. It's geometric, fueled by HBM scarcity. Micron is it's transitioning from a cyclical commodity stock to a high-growth AI supplier.
That makes the fundamental case feel, ironclad. Okay, let's shift to the technical side. Fundamentals provide the fuel, but the technicals, they dictate the velocity. We need to dissect the psychology of this blue sky breakout.
Right, so a blue sky breakout is just a term for when a stock shatters its previous all-time high. It's now in uncharted territory.
Like leaving the atmosphere.
That's a perfect analogy. All the old gravitational pull, all the psychological barriers are just gone. The stock is floating in a vacuum of resistance.
But what about this specific move told the analysts it was institutional conviction and not just, retail hype?
Two things, and they're really clear in the report. First, the way it broke out. The stock gapped up at the open, right, to $318, and it never looked back.
So it didn't slowly climb?
No, strong gap up like that. The sustained buying all day, that's the hallmark of big funds buying at the open. They're confident.
But the really unique part is that concept of no resistance. Can you help us understand the psychology there? Why is going higher sometimes easier than breaking an old ceiling?
It's pure human psychology, which just translates directly into supply and demand. So imagine a stock's trying to break an old high of, say, $300. Below that price, you have all these investors, we call them bag holders, who brought at $300 5 years ago and have just been waiting. As the price gets close to $300, they all see their chance to get out, to break even.
So they flood the market with sell orders.
And create this huge supply wall.
Exactly.
An old resistance level is basically a monument to past mistakes.
But once you break into blue sky,
that wall evaporates. Poof! Everyone who owns the stock is now in profit. Their impulse isn't to sell to get their money back. It's to hold for even bigger gains.
And that creates a vacuum.
A technical vacuum that lets the price float higher and faster than anyone expects.
And was this confirmed by, the essential ingredient volume?
Oh, absolutely. The reports stress the immense volume on this surge. It's the confirmation that this is not a fake out.
So this is big money.
This is big money positioning for 2026. They're buying with a multi-year horizon because they believe this HBM story is far from over.
That is a compelling technical case, but we have to address what I'm sure you are thinking right now. After a move this fast, how can the analysis possibly claim that $343 is not expensive? It just feels like froth.
And that skepticism is smart. But it's also the trick of a supercycle. The report's counterargument is all about forward-looking valuation. Remember, we expect earnings per share to double.
Right.
When you factor in that massive earnings boom, the stock is, well, it's arguably trading at a forward price to earnings multiple of less than 10.
Less than 10 times next year's earnings. For an AI leader, that seems anomalously low.
It's a huge anomaly.
The average S&P 500 company is, what, over 20 times current earnings?
Exactly. It suggests the market still hasn't fully priced in the profitability of HBM. Other AI players trade at 30, 40, even 50 times forward earnings. Micron at under 10x is, well, it's the definition of a gap between the current price and the future value, assuming those earnings come through.
And that undervaluation is probably why we're seeing all the analyst upgrades.
Oh, for sure. The report says the street is chasing this stock. They're trying to catch up to reality. We saw a flurry of upgrades right after the breakout, with targets getting jacked up by 20, 30%.
They're trying to make $343 the new floor, not a ceiling.
That's the consensus, yeah.
So where does the momentum push the price next? What are the key psychological magnets?
In a breakout like this, round numbers become really important. The report highlights the next major immediate milestone is $350.
Which is almost right there.
It is. And clearing $350 is seen as crucial because it validates the move and, according to this analysis, it opens the road up to two higher targets, $400 and then maybe even $500.
Wow.
And the report frames this whole moment with a really powerful analogy. It calls this the NVIDIA of memory moment.
Okay, that's a bold comparison.
It's very bold, but it suggests Micron is poised for that same kind of multiple expansion NVIDIA saw when the market finally got the AI story.
Yeah.
And the HBM supply constraint, well, it validates the parallel.
That really ties the whole thesis together. All right, let's turn this into actionable strategy for you listening right now. What's the recommended game plan here, both for people who already own it and for those watching from the sidelines?
The analysis gives a bifurcated strategy. So
Right.
for those who are already in Micron, the advice is classic bull market discipline.
Let your winners run.
Exactly. Trail your stops and let winners run. Don't get emotional and sell into what is clearly sustained institutional buying.
Okay, now for the hard part. For those who see this huge green candle and feel that urge to just jump in right now, what's the advice? Isn't waiting for a pullback just a form of market timing?
It's a critical question, and the analysis is very disciplined here. They stress do not chase the absolute peak of that breakout candle.
So wait for some consolidation.
Yes, for risk mitigation. The report specifically targets the $330 to $335 level. That range is significant. It's the point where the stock broke free from the old high. If it pulls back there and buyers step in to defend it,
Then that old ceiling becomes a new floor.
a new, incredibly strong floor. And the analysis calls that holding pattern the golden entry for the next leg up.
So it gives you a defined level of risk.
It does. And the final strategic principle is unwavering. This is a bull market. Micron is leading the AI memory charge. And betting against this trend right now means you are betting against the supercycle itself.
A very comprehensive verdict, so we've really distilled it down. You have the structural power of the HBM shortage boosting margins.
The 57% revenue growth feeding that doubling of EPS.
And the raw technical power of the blue sky pattern, which just removes all that old resistance.
And that leads us to the final provocative thought for you to consider. The whole analysis, this whole road to $500, hinges on that forward PE of less than 10.
Which seems like a huge margin of safety.
It does. But that aggressive target also relies entirely on the supercycle maintaining its current, almost infinite velocity through 2026. So given the astronomical expectations now built into the stock, the question is this: how much does that margin for error shrink if AI demand in 2026 softens even slightly? What if that doubling of EPS falls short by just, say, 10%? That low forward PE suggests massive undervaluation, but it also means the risk-reward now hinges on perfect execution in a very crowded space.
The ultimate high wire act of the supercycle. Thank you for